This is View from the Top. I'm Modile Sharafa Yusuf, and I thank you for joining us today. A few years after the financial crisis, regulation still occupies retail banker executives' time and resources. Thankfully, bankers no longer feel overwhelmed by the constantly shifting rules, but analysts say investor sentiments towards Nigerian banks have gone from positive to even outright fear. This, they say, is linked to the falling oil prices, likely spike in bad debts, and continuing political uncertainty. Industry players and analysts have also said that a number of regulatory measures aimed at stabilizing the economy would make it difficult to make higher profits this year. I will be discussing these and other issues with the Group Managing Director of Access Bank, Mr. Herbert Wigwe. We thank you for joining us, Herbert. Thank you very much.
Thank you very much, Modele.
Over the past 26 years, Access Bank has evolved from being a mid-sized bank into one of the 5 largest banks in Nigeria in terms of assets, loans, deposits, and branch network. Herbert became CEO and Group MD after succeeding his friend and business partner, Wigwe, in January 2014. Here are some other things I'd like you to know about my guest before we settle down to our conversation. Herbert Wigwe was born on August 15, 1966. He has a degree in accountancy from the University of Nigeria, Nsukka, an MA in banking and finance from the University College of North Wales, and an MSc in financial economics from the University of London. He is also an alumnus of the Harvard Business School Executive Management Program. Herbert Wigwe began his career at Coopers and Lybrand, Lagos as a management consultant. After a stint at Capital Bank, he joined GT Bank, where he rose to become the executive director in charge of institutional banking. In 2002, Herbert and Wigwe acquired what was then a small commercial bank, Access Bank, and Herbert served as the deputy MD for 11 years. He has also been chairman of Access Bank Ghana Limited, Access Investment and Securities Limited, Central Securities and Clearing System, and is the current chairman of Access Bank UK Limited. He is a fellow of the Institute of Chartered Accountants of Nigeria, a fellow of the Institute of Credit Administration, and an honorary member of the Chartered Institute of Bankers of Nigeria. Let me start by asking you, how has banking changed since you first entered the industry?
It is a totally different industry today. First of all, Nigerian banks have grown. At the time we started banking, I'm not sure you'd have seen any Nigerian bank amongst the top 1,000 banks in the world, perhaps apart from First Bank at the time. Nigerian banks have moved from that kind of position. Today they occupy perhaps anywhere between number 150 to 300 banks in the world, which is a very significant leap. And in the case of the continent, what you would find is that Nigerian banks are easily one of the top 10 banks in the continent. Now, if you go back 20 years ago, you wouldn't see them amongst the top 10 banks in the continent. In fact, the smallest South African bank was larger than all the banks put together. So from a size standpoint, the banks have changed phenomenally. Secondly, I think what you would also see is that the banks have become deeper in terms of the products and services that they render. Thirdly, the quality of service. If you just think back to the days of where's my tally number, waiting in the branches for days, all right, to get money. It doesn't happen again. So from a service standpoint, the banks have become a lot more sophisticated. Finally, from a risk management standpoint, I think things have changed a lot. The events that came up in 2008, 2009 helped to reshape the entire thinking of banking professionals. And so in 2014, 2015, I think the banks have become a lot more risk conscious, have a stronger awareness of risk management. So a lot has changed in the industry coming from 26 years ago.
Despite those achievements you mentioned, there is the continuing perception that banks have not been able to translate their growth to boosting the real sector of the economy.
Yes and no. If you go back 26 years ago and you look at industries that were being supported, the largest industries, what was the size of banks? They could hardly set up large industries. Today we have industries that are some of the largest in the world. The likes of Dangote Industries are Nigerian-owned businesses and are supported largely by Nigerians. And there are several others like that, perhaps not as big, but very significant. You didn't have banks that could lend $50 million, even as recent as 15 years ago. Now it is different. Banks are able to lend a lot more. However, there is some truth to the extent that there is still so much work to be done. Now, how is that going to be solved? It's a function of several things. I think the overall structure of the Nigerian economy has also affected the capacity of banks to lend to the real sector. So I give you an example. If you take what is happening in today's market, where because of the fall in crude prices, all right, the central bank has had to basically come up with certain monetary policy measures to ensure price stability, all right, inclusive of increasing the cash reserve ratio. By definition, all right, the overall cost of funds goes up and interest rate structure goes up, and therefore your capacity to lend to the real sector is immediately curtailed. It will all be resolved, okay, over time. The central bank, working with Ministry of Finance, etc., will come up with different palliatives or measures that should resolve all of it. Now, so much more still needs to be done. The banks need to, if you like, go deeper into the markets. The level of financial inclusion, the amount of money outside of the formal sector needs to be brought into the formal sector, all right, for banks to start having longer term money, all right, to support the real sector and at affordable interest rates. So yes, things have changed, but honestly, we still have a long way to go.
You mentioned the CBN now. What does the new CBN directive on foreign exchange utilization mean for the economy, and how will it impact the banking sector?
These are very interesting times, very strange times as well. Very uncommon times, as we would say. I think the current central bank policy measures have come out of the fact that we found ourselves in a situation where the foreign currency available to banks or to the country as a whole has reduced significantly. Now, when those type of things happen, you have to also look at the demand side and ask yourself, are some of these things that we do, are they right? And you come up with measures without violating the World Trade Organization issues to manage and curb demand. So that is what is happening, okay? And the central bank is being very cautious in trying to ensure that it ensures one of its principal objectives, which is price stability. Now, it means a lot of things. It means it's a time where all of us have to tighten our belts. It means it's a time when we have to basically ask ourselves, what are people importing? Let it be essential imports, let it be imports for critical industries, etc. Rather than allowing ourselves to importing all sorts of things, as we would have done in the past. It will also pass. But I think what is likely to happen over time is that we're going to have an all-inclusive policy, all right, which would address other aspects of the demand which have not yet been addressed, so that at the end of the day, the price stability rule which the central bank seeks to achieve, all right, by ensuring that the demand for dollars is real, okay, and therefore the overall price, given the supply which we have, all right, is such as to ensure reasonable price for the dollar.